What's going on, guys, and welcome back to another video. So it seems like every single day there's another video being uploaded to YouTube where somebody is telling us that there's going to be a market crash, but nobody seems to care about how we should prepare for a market crash or the kind of stocks that are actually good in the event of a market crash, right? So a couple of weeks ago I uploaded a video where I said that defensive stocks such as British American Tobacco are actually very good in the event of a market crash, right? So effectively, the premise behind that is that you put your money into a stock which is trading at low multiples, and then if there is a correction, effectively what you can do is you can pivot that money from the low multiple stock into the stocks, the sort of higher growth stocks, which will have fallen by a greater amount. Anyway, is there going to be a market crash? Absolutely. Do I or anybody else know when that's going to be? Absolutely not, right? So there's no point in getting caught up in it and worrying too much about it, right? So as long as you have a diversified portfolio and you're investing in solid companies, then you can be fairly well protected. And if the market does correct or if it does crash, then you can continue to buy more, right? But here we're going to talk about Lockheed Martin Corporation, because this is a fantastic company to own if you are concerned about either higher inflation causing a market crash or any other external market factors, right? Because I really find it hard to believe that you can really lose much money investing in a company like Lockheed Martin, right? So we'll go through some of the fundamentals and I'll show you exactly why I believe that. So Lockheed Martin Corporation is the largest defense contractor in the world, right? And we've got quite a nice overview here, which reads, Lockheed Martin Corporation, a security and aerospace company, engages in the research, design, development, manufacture, integration and sustainment of technology systems, products and services worldwide. It operates through four segments: aeronautics, missiles and fire control, rotary and mission systems, and space. So as I said, this is the largest defense contractor in the world. It has fantastic fundamentals. It's continually growing, right? Its revenues are growing, its profits are growing, and yet the stock price has not grown in that time, right? So we can see by this chart here, over the last 3 years, this stock has returned absolutely zero, right? 0.7% over the last 3 years. So somebody might assume, well, then what's the point in investing in a stock which has not moved, right? And it hasn't really returned anything to its investors over that time, apart from its dividend yield. The point is this though, right? That over the long term, fundamentals and valuations do normalize, right? So in the short term, the stock market is a voting machine, and in the long term, it is a weighing machine. Therefore, if a company's fundamentals continue to improve over time, it's only a matter of time before the valuation of the company eventually catches up, right? So we've got this chart here, right, which shows revenues, EBITDA, and net income. And we can see that in 2018, revenues were 54 billion. In 2020, they were 65 billion. EBITDA was 7.7 billion in 2018, and EBITDA in 2020 was 10 billion. Net income 5 billion in 2018, and it was 7 billion in 2020, right? So this company is continuously growing. It's a very steady grower, very reliable company, and yet the valuation of the company has not caught up to reflect that. But I do think that that will change in the future, right? And I think that this is a stock what somebody can hold, and they can not worry too much about losing money, and you can compound quite nicely, right? They pay a nice dividend, and also I think you'll get some capital appreciation there as well. And I'll go through the fundamentals to explain exactly why I believe that. And over the last couple of weeks, right, Lockheed Martin has been making the headlines for all of the right reasons. So we can see here that Lockheed Martin wins $6.6 billion deal for the sustainment of F-35 jets. And in addition to that, on the 23rd of September, Lockheed Martin management announced that they would be raising their dividend by nearly 8%, and that they would also be buying back $5 billion worth of shares. Now, whenever a company buys back its own shares, they are signaling to the market that they think that the company is undervalued, right? And who knows the company better than management? And I have to agree with them here. Now, they have a pretty decent balance sheet as well, right? So they've got just under $3 billion in cash, and they've got total current assets of $21 billion. Compare that with total current liabilities of $15 billion. So they've got a current ratio of greater than 1, so they can easily meet all of their short-term obligations. Now, we can see that they do have just over $12 billion in debt, but that's really not a problem for a company that's generating over $7 billion in free cash flow year over year. So they can easily service the interest payments of that debt as well as pay it down over time. And that is exactly what we see here on Simply Wall Street, right? So LMT's debt is well covered by operating cash flow, and LMT's interest payments on its debt are well covered by earnings before interest and tax. So there's definitely no concerns from a financial health perspective of the company, right? We move further down and we can see that they have a dividend yield of just over 3%, and that is, of course, is going to increase following the 8% increase that they've just announced. Despite that strong dividend yield, it's actually a really safe dividend, right? So it has a reasonably low payout ratio of just 39.5%, and therefore LMT's dividend payments are well covered by earnings. With that being said, it's not all positive for the company, right? So over the last 6 months, there was 4 people within management that actually sold 22,000 shares, representing $8.4 million. So we don't really want to see management selling their shares. If anything, it would be nice if management were actually buying shares. And that just goes to show that they have confidence in the business. So we'd have to look a little bit further into that as to why this management team here are actually selling down their shares. Now, it's not necessarily something that we should be concerned about straight away, right? Because there could be a number of reasons why management sell their shares. So for example, if they've had a load of options which have just vested, and therefore they've received a load of shares and they don't want to increase their holdings within the company, then they're going to sell off those shares that they've just had vested. So you'd have to look a little bit further into that as to why they have sold their shares. It's not necessarily a red flag on its own, but it's definitely something that you might want to look into. So then that brings us on to my valuation for the company, right? And I've actually changed slightly the way in which I present this data, but the calculations and everything behind it are exactly the same. So what we have here is we have the income statement forecasts, and then if we move across, we've got the discounted cash flow. I've done that separately now, just so it's a little bit less busy all on one sheet. And then we've got the fair value of the company, which we'll come on to in a minute once we've gone through the inputs. So the current market capitalization of the business is $95 billion. I've gone for a 3 to 5 year revenue growth of just 5%, and that is pretty conservative. In terms of years 1 and years 2, I've actually gone for analyst estimates, right? So analysts are expecting $68 billion in 2021 and then $71 billion in 2022. And each of those represent a 4% increase. So I've plugged those into my forecasts here, right? And then from there onwards, I'm using my own estimates and forecasts. So for years 3 to 5, I'm actually anticipating a slight increase in their revenue growth from the last 2 years up to 5%. And there's a reason for that, right? So if we actually look at the revenue growth over the last 4 years, we've actually seen an average of 8%. And if you go back even further than that, if you go back over 10 years, it's a similar story, right? 8, 9, 10% revenue growth per year. The only reason why we're seeing a slight decrease in 2021 and expected to see that sort of declining growth in 2022 is effectively just due to COVID-19, right? So there's slightly less spend on defense while the economy effectively tries to sort out this mess that we're in, right? But I expect that from 2023 onwards, they can easily achieve 5% revenue growth. Now that is still conservative, right? So 5% for years 3 to 5, and then for years 6 to 10, I've actually gone with just 3%. So very, very low growth. As you guys know, I like to be realistic, but also very conservative because that way I reduce my risk, right? I reduce my risk of depreciating my capital. Now for gross margins, I've actually gone with 13%, which is the average of the last 4 years. The way that Lockheed Martin actually account for their cost of sales and expenses is quite unique, right? So you can see here that their gross profits are actually more or less the same as their profit from operations. And it is quite strange, you don't often see that, right? But just to show you what that looks like in their income statement, when we go across here, right, so we've got gross profit of $2.1 billion, and then they've actually got operating profit of slightly above that at $2.2 billion. It's just a little bit unique in the way that they're accounting for things, but it doesn't really matter, right? Either way, we're going to include all of those expenses within our forecast. So that is actually why we have a negative percentage here of 0.4% for our operating expenses. That's because they have a slight amount or a small amount of other income, which isn't typical of their standard revenues, right? So they include that within their operating income or expenses. It doesn't really matter, we contribute or we include that within our forecast going forward, and it's also immaterial to the forecast anyway, so it's not that important, but I just wanted to point that out. We've then got a weighted average cost of capital of 8.2%, and they've got cash and cash equivalents, as we was alluding to earlier, of just under $3 billion, and they've got total debt of just over $12 billion. Now, when we move on to their free cash flow, right, so I've taken their earnings before interest, tax, depreciation, and amortization, and then I've made all of the necessary adjustments so that we can arrive at the unlevered free cash flow. We then apply a discount rate to that going forward, and we can see here that I'm actually expecting that unlevered free cash flow as a percentage of EBITDA will be 57%, which is effectively the average of, well, 4 of the last 5 years. I've excluded 2017, and that's because they had an abnormally large tax expense in 2017, which we're not expecting to continue going forward. So it wouldn't be fair to include that in my forecast going forward, right? So 57% as a percentage of EBITDA. Terminal growth of just 2%, and there we can see the present values here of those future cash flows. So then when we come on to the fair value estimate, we've got an intrinsic value per share according to the DCF of $367, and we've got an intrinsic value per share according to the earnings multiple, which is based on a PE ratio in 10 years time of 16. Now 16 is their historical average over the last 10 years, and considering that this is a mature business and it has been over those last 10 years, I think it's fair to apply a PE ratio of 16, which is a historical norm. We get an intrinsic value of $346, You combine the two and take the average, we get a fair value of approximately $356. So that gives us a margin of safety of only 3.6%, right? Which doesn't sound very good. However, you have to bear in mind that this is a very safe company, right? I've used very, very conservative numbers in my forecasts, and actually in a broader market downturn, in a correction or a crash, whatever you want to call it, we wouldn't expect Lockheed Martin to fall anywhere near as much as what you might expect some of the high growth investments to fall, right? So in that case, if there was a market downturn, what you could do is effectively take your investment from Lockheed Martin and put it into some of the more high growth companies, which have higher growth opportunities, but which have fallen by a greater amount. Okay, so I think that today the company is worth $356 using very conservative numbers, but what is the company going to be worth in 2025, right? So what I've done is I've used an enterprise value to EBITDA multiple in order to arrive at that number. So we've got 2025 revenue of $82 billion, an EBITDA margin of 15%, which is in line with what they're achieving at the moment. Now that gives us a 2025 EBITDA of $12.3 billion. And effectively, I've just pulled that from the discounted cash flow, right? So if we go to 2025, we can see that the EBITDA in 2025 is $12.3 billion. And then we need to determine what we believe an investor might be willing to pay for the company in terms of a multiple in 2025, right? And I've applied 12.5. And the reason for that is I've gone to their enterprise value to EBITDA multiples over the last 3 years. So in other words, this is showing what are investors willing to pay as a multiple of EBITDA over the last 3 years. And we can see that the average was 13, highs of 16 and lows of 10. If we actually go back even further than that and we go back 5 years, the average was slightly higher, the highs were higher and the lows were pretty much the same, right? So I think that 12.5, which is below what the current mean is, I think that that's fair. So I've applied 12.5. That gives us a 2025 enterprise value of $154 billion. And then I've taken the current shares outstanding and I've reduced those by 1% year over year. So in other words, I'm expecting Lockheed Martin to buy back 1% of their shares every single year. Now, considering the news that's come out that said that they're actually going to be increasing their share buybacks and they're going to be buying back an additional $5 billion of shares, this actually is probably too low, but I'm going to leave it as it is for now. So historically, they have done very well in buying back their own shares, which increases effectively our proportion of the pie that we own, which is very good for the shareholder. But to remain conservative, I'm just going to assume that they're only going to buy back 1% of their shares per year for the next 4.5 years. That gives us a 2025 price target of $545, which is a compounded annual growth rate of 9.5%, right? Which is good, but don't forget that that doesn't include the dividend yield, right? So you've got a 3.5% dividend yield. So actually your return here is around 13% per year, potentially, which is a very nice return. If you manage to do that year over year for the rest of your life, you'll have outperformed the S&P 500, or in all likelihood you would have done. And so yeah, it's definitely not a bad investment. And I also think it's a very safe investment. So I hope you enjoyed the video, guys, and until next time, thank you.